And we are going live. Well, hello and welcome everybody to another Tuesday about how to accelerate personal debt, live the lifestyle that you're wanting to live, making that change that you want to see in the world today, helping your family succeed, get out of those student loans, those home loans, and everything else revolving debt and getting out of debt. We have a special guest tonight, Mr. Richie Galars Coast. I hope I said that right. Close enough?
Yeah, you
Hopefully.
always do. You're fine.
Don't. All right. So before we get started, let me tell you a little bit about Richie. Richie is currently the CEO of GP Holding LLC, a real estate investing company out of Hawaii with $1.3 million portfolio. In his previous company, he spent 3 years teaching and training people on the credit banking strategies to help them eliminate their debt in 1/3 of the time, save thousands of dollars of interest in real estate, on their debt, and currently focuses on helping people get out of the rut that we were designed to live in and break free and move towards financial freedom so they can spend more time with their family, live that lifestyle that they want to on their terms, seek that validation and receive that validation that they haven't been receiving, and just flat out be stimulated both intellectually, mentally, and you know in their career and everyday lives. So I'm going to go ahead and pass it over to him because tonight he's going to take you through an success when it comes to going to the bank, applying for lines of credit, because you're going to need that debt weapon or that debt tool, line of credit, to actually be able to implement these strategies. All right, Mr. Payne Coast, let's see here. Do you need to be able to change, do you need to be able to share your screen
Yes, I'll be
okay.
drawing some things out, but not all the time. Just
Okay. All right. Go ahead and take it from here.
excellent. Thank you so much. And for those who are on, welcome. For those who are streaming on YouTube, hey, how you doing? Thank you so much again for Wise Guys and Ties. You guys are amazing. Thank you, Ray and Joey, for inviting me on again to be able to share what I got. And my knowledge is, it's always just really neat to be able to create some paths for people who take this information in and apply it. Okay, now the benefit to me is that this idea is spread throughout the nation. It's something that I truly believe the banks leave for us to give us to give us a tool to deal with them. I'll be honest with you. I was never ever a fan of when anybody tries to talk about this type of strategy. It's against the bank. The banks are evil and all that other crazy stuff. By all means, you got to realize that the banks are giving us these tools. They're just not teaching it to us. So if you go to the teller, if you go to the banker, it's not their job to set you aside and say, hey, this is how you should qualify to get the line of credit that you want, or this is how you should move your money to pay down debt and pay down interest, or this is how much cash flow you should have, and so on and so forth. There's nobody there to teach that. And so our goal is to, in my company and everything, is to always help people, take the reins and stop relinquishing that responsibility on somebody else. With this knowledge, you have that ability to go and do it yourself and eventually be able to teach it to other people. It's just, I think it should be the natural order of things. This amazing strategy helps so many people from when I was helping them, when I was, doing one-on-one clientele. I helped people from homelessness, bankruptcy, all the way up to one billionaire and a few millionaires. And everybody in between all that. So, needless to say, this strategy is for everyone. It's not just for those who don't have who don't want who want to get rid of debt, right? Thank you so much. See, look, my wife, she just served me one of these little frothy um, coffees. So good. Mm. Anyway,
That
so
absolutely looks delicious.
it's amazing. I don't know if you heard the whirring behind, but it was the blender going. But I feel that that this strategy could work with anybody, whether it be trying to get into a better position for credit, for someone who wants to get rid of the debt that they may have created over time, and someone who wants to grow their wealth. In all essences, those three types of people are everybody on this earth. So we haven't we don't miss anybody with those three types of people right there. So if we want to target those three types of people and give them that ability to change their lives with this strategy, then this is the way to do it. Right. So I am from Hawaii. My name is Richie Glarz Pankos, just like Ray says, and I've been here since all my life. Me and my wife, we grew up. You know, uh, we grew up with the lessons of work hard, get good grades, get a good job, and make your dreams come true. And shortly after, getting good jobs, dreams not coming true, then we felt like we missed something. And in comes these trainings, and we just open ourselves up to all these different strategies out there to figure things out. Now, by all means, we got hit with all those other things, those MLMs out there, or those these life insurance things and all this other crazy stuff, and we just weren't having it. And then one day, my buddy, on Halloween night, 2013, he comes to we go over to his house for Halloween to trick or treat, and he sits me down, because I haven't talked to him in about a year, and I was wondering, what have you been doing, man? He tells me, well, I'm in this system. I'm in this program that teaches, finance strategies. I'm like, oh, that's interesting. Tell me about it. Say, well, I can't really tell you about it right now. I'm just going to tell you that it's amazing, but you need to see the numbers. And what's funny is because he targeted me, he knew that I'm all about the numbers, right? So he goes and says, meet with me on Monday, and we'll just, we'll fill this form out, and then, we'll see what's possible. At the end of that meeting, learned a lot of things about this whole credit banking process and everything like that. And needless to say, I couldn't sleep for the next week. I could not sleep. My eyes and my dreams and everything just became wide open for me. I saw this light at the end of the tunnel because these numbers blew my mind. And I just got hooked. I just needed to focus on making this work for me and making this work for my family, and so I got into it. I left my job to be a part of this company, just to learn how they made my life change. In other words, my goal at that point when I first was being taught was to pay off about $36,000 of student loan credit card debt as soon as possible. Little did we know, as we were able to make it done, pay it off in 6 months. 6 months to pay off 36,000 in student loan and credit card debt. So we were just like, okay, let's just focus on this. Let's just figure out how to make this work and how to make our wealth grow from there. And it just so happened that the owner of the company saw what I did, and he saw like, well, we need more instructors because our company is growing. Please come out and join us, and I'll pay you. I'll match your price with whoever you're working with, and so on and so forth. I come from IT, so my rate was pretty high, and he matched it. So we just made it happen in that fashion. It was great. And so here we are, since 2013. Now it's a good 7 years later. And now we're in real estate. We're running businesses, and, making the dreams, building the dreams up as much as we can at this point. I'm not a big fan of understanding that I'm not a big fan of instant gratification, right? But I am a fan of planning, hard work, and using these mental strategies and these financial strategies to build the dream blocks that you want in your life, and taking the responsibility to do that. So that's what I've been doing. And it's a process, it's a work in process. But now it's like, we're living in a beautiful house in Pearl City, Hawaii. And this house is in a first position home equity line of credit because that was the best option for us at the time, and it still is. and our payment was 2,600. We dropped down to $600 a month. So these types of really amazing strategies that we did cater to our situation. But when I started working with this company, I started realizing, you know what, my situation is not everybody's situation. It's everyone is different. And the more I worked with the banks, every bank is different. So write that down. Everybody's numbers are always going to be different, and every bank or banker is going to be different when you work with them, because we're going to be talking about qualifications today. And just being able to put so many people through the process of making this happen for themselves, it gave me that idea of, well, let's focus on building our wealth through real estate investing, through entrepreneurship, and making the money that I want to make instead of making the money that a company wants to make, for themselves. And I didn't want to be that human resource anymore. And so here we are, just building businesses and teaming up and collaborating with amazing companies like Wise Guys and Ties, and other places. So um, that's basically my story. We could get into more detail if you ever want to, get into that. But otherwise, let's get down to business. We're going to talk about um, the qualification process. Now, one of the things that I realized when I did work with a lot of one-on-one clients before was that was missing with a lot of people. They would get the idea, they would get the concept, they would understand, okay, a line of credit or a business line of credit, home equity line of credit, personal line of credit, a credit card, or even a savings account, a 401k account, a TSP account. All these different revolving accounts can be a credit banking account. But how? Like, how do you get those accounts? Well, pretty simple to get a 401k account. You just go ahead and work and go ahead and start contributing and having your company match it. And if you happen to be a part of a company that does a really amazing matching for 401ks, like I was before I got into all of this, crazy stuff, um, that's always a good thing. It's basically technically free-ish money for the time being anyway. You're always going to have to pay interest. Believe me, you're always going to have to pay some kind of interest or fee for that kind of money. But just for now, just realize that it can become that revolving account that you need to create that credit banking account to do this amazing strategy. Um, if it comes down to is using a savings account or money under your pillow or whatever it is, it's the same thing. It's a revolving account that you can put money in, take money back out of. But let's talk about going to the bank and qualifying the ones that don't use your own money, use the bank's money, right? Those are my favorite. I like using the bank's money more than anything, which technically, if I have money in my savings account and my checking account, then chances are I'm using my own money because the bank is basically lending it back to me at a higher rate. So just throwing that out there if you guys don't realize that, that's how arbitrage works. Anyway, so one of the first things that I talk about, let me go ahead and share my screen. Is that okay, Ray? I'll go ahead and open up
Yeah,
my.
go for it. Are you able to?
Yeah, let me see if that works. Does that work? Do you see it? My OneNote?
Yeah. We're there.
Okay, excellent. Thank you. All right, so I'll limit my drawings because I have really bad handwriting. I do come from the IT world where everything is typewritten. All right, so let me see if I could just kind of blow this thing up here to 36. Okay, cool. So when it comes to qualifying for these bank products, uh, the main thing is number one, you must have your plan already in place. If you've already run your numbers, if you've already decided you want to use this strategy, then now's the time to get the tool that you need. Okay, so what I'm going to do is I'm going to start from the bare lowest end of the spectrum. Okay, this is where, and I'm not saying low as in berating. I'm saying this is where some people just have to start to get to the point where they could actually accelerate everything. And like I said, I've worked with people in the ruttiest of ruts and help them gain that ability to get to the point where they need to, where they could actually get the big lines of credit that they desire to do this strategy. Okay, so uh, I'm going to give you an example. So I had a client who had just filed for bankruptcy. She just went from through a divorce, and she filed for bankruptcy, meaning that her credit is way down in the toilet. And from one of our other instructors, everybody, this person always says it's not because of the divorce, it's because of the lack of communication and all the things that could have happened between the couple that made credit just drop down. And so when I heard her story, and she's like just trying to recover all by herself, single parent at that point, and her car is beat up, but she needs work. She needs a ride to get to and from work. And well, I felt that I knew I could help her in a certain way as long as she just followed the process. Okay. So one of the things that banks typically look at, of course, is credit score. Okay. Now, when it comes to credit scoring, of course, we have to understand deep down inside that we probably will never, ever understand credit scores and how they're actually done. There's a few people that I know who do, but all in all, you really don't really need to delve into exactly what makes your credit score do its thing. It just comes down to, are you doing what needs to be done to make the bank comfortable with you? Okay, that's basically what a credit score all it is kind of like a relationship score. What's your relationship with the bank? And if your relationship is in the rut, just like your relationship with a divorce or a bankruptcy, then unfortunately that's something you're going to have to fix. And so what I basically helped her do is set up a strategy to 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 uh, to be able to hit the credit score multiple times a month in a positive way. Okay. Majority of the time when people go into lower credit scores, they say it's like, oh man, this is gonna be so hard to work back up. But if you knew the specific ways to, for lack of a better term, manipulate a credit score by using their own tools, the bank's own tools, to make that happen, but there's also the other ways of going through a credit monitoring or a credit fixed service or whatever. There's those processes as well. But what I did was I basically told her to follow a process by opening up a certain type of line of credit with a specific bank. Now, one thing that you always have to keep in mind, and let me put this in red because these are the rules of the of the whole entire process of qualifications. Okay, and that is rule number one: all banks are different. No, that's supposed to be red, but I'm just going to do this and paint it red. All right. All banks are different. Okay. You can't, there's no standard for someone to go into a bank with, let's say you go to US Bank, right, to qualify for something, but then you used Bank of America's qualification standards. That won't jive. What you're going to find out is US Bank has a different qualification process or different underwriting process than the other banks out there. And I'm just using those as an example, just so you know, I'm just using those as examples. But just understand that all banks are different. When you go into that mindset of understanding that all banks are different, then that means that you're going to start to realize that you need to study a little bit. You actually have to kind of work. Unfortunately, nobody's going to be able to hand these to you. So this is where it comes into your specific area and your specific bank, and the place that you want to be able to research. You're going to have to ask questions. You're going to have to build a relationship with these banks and get an idea of like, what do they use to qualify, and so on and so forth. So in this particular bank, for this bankrupt woman, they offered secured lines of credits. In the secure line of credits, they reported to the major credit bureaus. Okay. And she followed the steps, she followed the processes, and her goal was to get her credit score back up from, I believe it was, let's say approximately, I think it was like 450. And her goal was to get to the 680 plus area. That was the goal. I'm not going to go through the whole process of her doing this. I'm just telling you that there is a process that she needed to work up to, okay, for the qualification. So to get her credit score up from 450 to 680 plus to qualify for the unsecured lines of credit that she needed to use a secured lines of credit. And so that secure line of credit, there was a total process with this, and I worked out with her how to move the money and align her bills and everything like that, what kind of cash flow she needs to work on. Believe it or not, in 6 months, she was able to qualify for that unsecured line of credit because of the steps that she took. Okay. So in this particular bank, they offered her because they saw her situation. Yes, she filed for bankruptcy, but they didn't. She didn't file for bankruptcy against any product that she had with them. So in other words, they kept her in that fashion. So also keep that in mind that if you did file for bankruptcy with specific banks, and they find out that you charged off on them, chances are sometimes those banks will not accept you back as a client. Just throwing that out there. But this particular one, they knew that she was in her situation, but they did not charge anything off. She did not charge anything off from the product that she was using with them. She actually worked out, a situation. But she did open that secure line of credit. She started working the process that I showed her to work, and in 6 months, she was able to bring her credit from the around the 450 to the 680 area. And then on, she was able to. It was really neat. Started with a $500 secure line of credit, and then it blew up to a $25,000 unsecured line of credit. And she was able to, get her car, get a new car actually with that line of credit and use it to pay down, use the strategy to pay down that line of credit, and then be able to keep working her way up from her bankruptcy. Now, by all means, her bankruptcy is still on her record, but that relationship she built with that specific bank was key to it all. This is a federal credit union, just so you know. It's not one of those big banks out there. The federal credit union, they see these types of things sometimes, and it's up to the discretion of the person who's looking at the account and the activity on the account and knowing the person. So, in other words, she built a relationship with one of the bank managers while she was going through this process, because chances are, I think the bank manager was going through the same thing she was going through. Pretty cool, right?
Yeah,
So,
we got a
yeah, go ahead.
question. So how do you feel just from knowing other folks that have gone through this strategy and really had success? Do you have a preference, large, well-known banks versus credit unions, or does it matter in your opinion?
It definitely matters depending on the situation, honestly. If, say, you're in an area that has a line of credit that would match your specific plan, and then there's a bunch of other large banks out there that don't have anything near it, then yeah, I would definitely recommend you going to that particular one, because you get to pick and choose who you want to work with in this particular situation. That's the beautiful thing about what we do is we're in control of this. We are in total control of who we want to work with and when we want to work with. But I'm never going to say that small credit unions have better products than bigger banks. I can't know that for a fact until I look at the numbers and run my own numbers. So I know that it's like one of those answers that's just like it depends. But majority of the time, it always comes down to what do you want to do, how do you want to do it, and who do you want to do it with. I don't necessarily only focus on small banks. I mean, we got some big banks. Well, relatively big banks here in Hawaii that's mainly focused in Hawaii, but they're also part of bigger banks on the mainland. And some of them are some of the ones that I recommend people to go to because their numbers match it. Go to the bigger bank because this specific feature or the ability to move money in a different way that matches their lifestyle and the client's lifestyle and their I guess you could call it comfort. You know, all of that has to come into play, right? Your movement of money style, your cash flow style, your comfort style, all these things come into play with every single person that I meet when it comes down to these, opening up a credit banking, account and understanding the banks around you. I mean, you don't need to totally nerd out like I do. You could try any bank out there. Don't get so fixed on the numbers. But when it came to me helping other people, I did my best to pick best one for their specific situation, right? If you want to get down to that point, then we'll become good friends. If you want to be that kind of nerd along with me, because it's just so fun to be able to say, oh yeah, this bank now offers this. They changed this and they changed this. All right, cool. I know how to, who to send to that bank when it's time, or I'll do it myself because it matches my situation better, or so on and so forth. It's very dynamic, which comes to my other point. Banks can change at any time, just so you know. It is a dynamic business. Uh, when this whole COVID-19 thing started coming down, I forgot which bank it was, but they halted giving out home equity lines of credit. Well, why is that? Well, they could change any time to their comfort level, to their risk tolerance, right? They feel that there's analysts out there who feel that home equity lines of credit are more risky than fixed rate loans, because they feel that people may be losing their jobs and they're going to depend on drawing out of their line of credit. And then when it runs out, they have no reprieve. There's nowhere to go. So they foreclose. And they don't want that. So they're scared of that, right? Which is why most of the time when you see home equity lines of credit as as a tool for you to be able to borrow from, the chances are the qualifications are way higher than the typical 30-year mortgage. Okay. So I hope that answered the question.
Yeah, no, it totally did. Absolutely. Absolutely. And that's a really good point. The fact that they can do whatever they want to mitigate risk as well.
Yeah, I mean, I think one of the biggest points too, let's call it number three, because this one just came up, and I think that Ray and Joey talk about this all the time when it comes to business credit. Think like the bank. Think like the bank. Understand who they want to lend to, and then be that person, or build up to be that person, right? Or exceed that person or business or whatever it is. But what it comes down to is understanding that banks misc banks risk mitigation tactics are solely dependent on the economy and the market, and the ability to adjust when it's time to uh, you know let's say get rid of those home equity lines of credit, or slow down on personal loans, and offer more of the higher APY savings accounts, and um, even getting rid of personal lines of credit or credit cards, because their fees with the bank that the credit card company that they partnered up with just got too expensive, and so they stopped using Visa and they decided to start using American Express. All these things change. You've probably seen this in your adult life when you start banking, is that they used to offer this, but now they offer this, and then they offer this, but now they offer this. Think like the bank. They're just basically trying to mitigate risk as much as possible. And so as a consumer, or as someone who can create their own wealth, and getting all that knowledge, building that relationship with the bank and understanding where they're coming from is going to be very key to growing your business if you ever want to keep working with them in these specific strategies. If it's just to pay off debt, you just want the basic simple things when it comes down to it, then by all means follow the strategies that Joey and Ray's been teaching all this time, or even get into the education that they recommend. I mean, I recommend it. It is the greatest education service in the entire nation, and learn about this stuff on your own. 24/7, pause, rewind, fast forward, and ask questions in these forums, because that's what we're here for. And if you ever want to get into that whole one-on-one situation, well, chances are it's going to come with a bigger price than what the education services offer. And for me, the more I look at these classes that's offered on this whole credit banking situation, uh, you know, I got to say it answers all the questions. It answers majority of the questions, actually. It just so happens that I was one of them that helped make that class. But anyway, so thinking like the bank is very, very important. So just so you know, when you go into the bank, uh, or let's say this, let's say you have $100,000 just in your pocket, and a someone you've seen comes to you, someone who you've had a relationship with, and you've seen them use borrowed money and return very well. Meaning that, let's say they wanted to borrow $50,000 from you to invest in a real estate deal that's secured against the property, and it's going to cash flow both of you very high amounts. Would you be willing to do that? Right. Well, because of all that clout that you have with that person, and that relationship that you have with that person, sure, you're more than willing to do that. I'm not saying you will, but I'm saying you're more than willing. But let's say the guy just came off the street, just walk up to you in a cafe and say, "Hey, I heard you got $50,000. Can I borrow it? I'm gonna go ahead and invest it in some real estate, and then it's gonna pay us a lot of money." Now think about the bank and how that particular subject, or that particular thing, that particular scenario happens every day with them. People with no credit, or zero relationship with the bank, people with bad credit, people with just all these different things happen to them financially. They come into the bank and ask for things. Well, you know what? You just wasted an inquiry as well on your credit score. So, keep that in mind, that having that plan going into the bank is always going to be you know, uh, very important. And so, in this particular bank with this lady, that credit score needed to be 680 and above to be able to get in their qualification standards. This would equal a $25,000 unsecured PLOC. Okay. Now, when I say PLOC, personal line of credit, it's basically like a savings account that you could draw cash from or write checks from. The thing is, though, it charges you interest. That's basically it. And if you have seen the things that Joey and Ray, train on when it comes to why lines and loans and the difference between the two, then you'll understand why this is actually a really good bank product. But the thing is, though, her credit score was not the thing that got her this amount. Now, the credit score got her approved, but not for that specific amount. There's another qualification process you got to go through. So let's say the credit score got to 680, a beautiful number for the bank. There's other banks out there that say, okay, you know what, nothing less than 750, but in this case, we're talking about 680 for this particular bank. Okay. The 680 got her approved. Okay. But how much is a different qualification process? Okay. So the amount approved for has to deal with debt to income ratio. Okay. So debt to income ratio, the other qualification process. So say you have a 780 credit score, great credit score, by the way, and you know what, you're maxed out on your credit cards currently, and the income that you make is basically taking care of every single credit card, minimum monthly payment every single month, and leaving you with like maybe $500 every single month. When the banks run those numbers, and they will, because, well, they have access to what you owe every month to the banks, their relationships, that all the banks report to the FICO system, or TransUnion, Experian, Equifax, and whoever else. All the banks report to those bureaus, and those bureaus basically collect all those datas, and then anybody who inquires about you through those bureaus, they're going to spit out, well, this is what this person actually owes every single month, every payment that is paid every month. And what they do, whenever the bank qualifies you for a loan, chances are they're asking you for a few things aside from the credit score, right? So they pull your credit report and everything like that, but they're asking from you to prove your debt to income ratio. is, so chances are they will ask for some paperwork. For example, last 2 paychecks or pay stubs, and your, last 2 years of W-2s, taxes, just to prove that what you're saying on your application, say, I make $120,000 a year. But when they pull your pay stubs and your W-2s and see that you don't, then you basically just kind of lied to the bank. You don't want to do that. I mean, some people would just go as far as saying, well, that is fraud because you are lying on a form of whatever, a financial form. But most banks will be all like, no, we're just going to deny you. Don't ever come here again or whatever. Debt to income ratio. So these are the things that they need to prove that you make the money that you say you do. Now, there are some banks out there. Some banks offer stated income, no proof. So here's an example of that. Say you got a 780 credit score. Again, same scenario. Credit score is high, and well, there's a bank over here that you could actually just go to. What they'll do is they'll pull your credit score, and that's basically it. They don't really pull the report and see what you actually owe with all these other places. And when you say that you have that you make $120,000 a year, they'll just take your word for it, and then approve you based on that amount. Believe it or not, whatever their limits are or whatever. Now, is that lying? Well, it depends if you're actually making that much. So, in other words, don't lie. Okay, don't say I plan on making 120,000. No, they're asking you how much do you make right now. So just keep that in mind. If you're not
Ooh,
there yet, yeah, go ahead,
question on that aspect.
go for it.
What about using on that? Is it household income typically, or is it just your income, or is that kind of the gray area?
It usually asks you what it is. Your gross household income is the last application I filled out, so I
Mm-hmm.
put in my gross household income. So that's what I did. I just go by
Perfect.
what it's asked for. So it's not necessarily a gray area. And the problem with that is if there is no specific guideline on how much you should put on there, and you ask the banker, they're going to be like, oh, I don't know. Believe it or not, just whatever you make, whatever you and your spouse makes, kind of a thing. So because that's basically how it goes. If you're applying for something under your social security number and your name and everything like that, if it says your gross monthly income, household income, then you put your gross household income. Just answer the question. That's the way I
Perfect.
see it. So the problem with this though is that as you work with that bank and you start using that product and you don't pay it back the way you should, they may look into you and find out, hey, can you now prove that you actually make 120,000 a year? This is what American Express did with me, which is really weird. Um, so I got an American Express, one of those metal cards, right? And uh, it's one of those like net 30 cards. You just pay it off every 30 days. And I did a big purchase on it, and then I ended up taking some of my business checking because it was a business expense. I transferred money from my business checking, to my personal account to pay for it. I just wanted to make that paper trail. Don't do this, by the way. I just wanted to make that paper trail, just to show that it was a business transaction. And then I used another business checking account to just move the money in and then pay for it. So they saw that I made 2 payments on it within a span of a week, and then that threw up a red flag with American Express. And you're like, whoa, 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 you've never done this before. Um, now we're gonna stop you from using the card until you could prove that you are actually making what you stated you made when you first applied for the card. You need to supply your W-2s and your last pay stubs and all this other crazy stuff. I'm like, oh, okay. So I threw it in, and then once they got everything, then they just let it go again. It's frustrating sometimes, but that's what the bank wants to do to mitigate risk. If there's a red flag that their automated system posts up because you did something different than you usually work, because every single month it's always been wipe out the monthly statement and through this one account. But when they saw me doing it from different accounts, that's when they threw red flags. So just throwing that out there that they may come back after you and say, hey, you did something different, can you prove it? Because you stated this, but now can you prove it? And this is like 3 years after having the card open, which is really weird. Okay, now the reason why debt to income ratio is very important to the bank is because they want to make sure that if you or this lady, let's say this lady, she got herself up to 680 and everything's fine on that side, but is she going to be able to afford a $25,000, well, technically a loan, according to their systems? And what they basically would do is they would run their numbers based on her income statements and everything like that. And this is the way they would do it. Um, what they would do is they would take your gross income. Okay. So say it's, just as an example, her gross income is $5,000. Okay. Now it's not taxes, insurances, and everything like that. This particular bank asks for gross income. There are banks who run the debt to income ratio numbers based on net income after taxes. Just so you know, all banks are different. Okay. Always keep that one in mind. So say the gross income is $5,000. And in her case, because she only had this this secured line of credit, which she actually grew to around $2,000, $2,000 secure line of credit. In their case, this equals a payment of whatever 3% the total limit amount is. Now, I'm gonna pull up a calculator. You might not be able to see it. I'm just gonna pull up a calculator. Actually, you know what? Let me just do this. I'm gonna stop my share my screen again, and I'm going to share everything here. All right, so you should see my calculator and my OneNote there. Is that right, Ray? Do you see that?
Yes, we can see
awesome. That. So what they would do is, because the limit of the secure line of credit, even though there's zero balance on it, right? So this would be zero balance when she applied for this $25,000 line. Okay. The secure line of credit payment, the way they would judge against it is they would take 3% of the total limit and count that as a payment to the bank. Okay. In other words, they'll take 2,000, multiply that by 0.03%. So $60 a month goes against her gross income as far as her debt to income ratio. Okay. They also look at rents as well. In her case, she wasn't renting; she was actually living with her parents, so that helped her a lot. Any other kind of bank pulled information, any credit cards or loans or mortgages, anything that's on the banking side, they're able to pull that and then calculate out how much she would be paying out of her $5,000 against that. Now, in this particular bank's case, and this is different from most banks or all banks, that debt to income ratio needs to equal 0 to 45% in this particular bank's case. Actually, no, 50% in this particular bank's case. This one is a 50% bank. There are banks out there who offer 45%, some offer 60% debt to income ratios, and then they calculate them differently sometimes too. I'm just showing you just one example. It's always very important to go to a bank and see if you can actually build a relationship with the bankers and the underwriters to find out how do they calculate their debt to income ratios for qualifications. It's interesting, but it's good to know too, so that way you could build that relationship and then be able to pick and choose who you want to work with. And then you could run your own numbers before you get to the bank. That's the fun stuff. So in this particular bank, they're asking for a 50% under 50% debt to income ratio. So if she's at $5,000, okay, as far as her gross income goes, and they're only minusing, or she only has a $60 payment, then her debt to income ratio is technically this. It's 60 divided by 5,000. Is that right? Yeah, 60 divided by 5,000. Her debt to income ratio is 1.2%, which is really low at that point. Okay. So at that point, they're like, okay, what can you qualify for? Well, she only needed $25,000. That's what she was asking for. So what they did was, well, if you close the secure line of credit, so let's say you close this, so you can strike through this or whatever. So let's say you close this. I'm going to go ahead and put it in red. And what you want to qualify for, so this is a 1.2% DTI. She wants to, apply for a $25,000 line of credit. So the car that she wants to get is only $15,000. She's not looking for anything crazy. It's just a $15,000 reliable car. And, she didn't want to max it out. She just wanted to use it for that. She didn't want to take out a car loan because she didn't want to work with another bank. Otherwise, it would just get all weird because it would see bankruptcy and then immediately offer her probably the highest rate possible. Still approve her, but offer her the highest rates possible. But since she knew this strategy, she figured she could open up a personal line of credit, an unsecured personal line of credit, use it to pay for the car. So when she got her credit score up, even though the bankruptcy was on her record, the bank was like, "That's fine. We see your activity. You're doing it right. Let's see what you could actually get from us as far as a personal line of credit goes." So if she applies for a personal line of credit of $25,000, then we do the math again. The limit, $25,000, multiply that by 0.03%. Now it's a payment of $750 a month. That's not what she's going to actually pay. That's just what they are judging it on. So she has zero balance on this $25,000. They're still going to use this as a way to qualify her. And so what they do is they take that number, 750, and divide that by $5,000, her gross income. Now she's at 15% debt to income ratio. Does it make sense? Because right then she was able to get qualified for that because she didn't have to pay rent or anything like that. She was able to qualify for that $25,000. Now, and that's how banks get their amounts. Sometimes you would ask for something and then they come back at you saying, hey, we could actually only offer you this amount. Well, that's because they ran your debt to income ratio against their numbers, and then they came with that specific amount that you could hit that debt to income ratio ceiling. And in her case, it's 50%, 50. So from 15 to 50, she still could borrow a lot more money if she wanted to, but she knew better. She wasn't going to do anything weird. But let's just say, as an example, let's just say she actually had a rent of $1,500 a month. Let's say it's $1,500. And she also wanted to borrow that $25,000, which is that $750 per month, that 3% of that balance. Hold on, we just. Sorry, my son just woke up and he's going nuts. Anyway,
the joy of the gift of child laughter.
Yes. He's happy. Anyway, so $1,500 for rent, $750 for this line of credit would equal $2,250. Then divide that by 5,000, and what you get is a 45% debt to income ratio. She would still be able to qualify for that $25,000 if she had to pay a $1,500 rent. But where does it start tapering off? Well, let's say she had another loan that she had to pay, I don't know, let's just say $1,000 on. Okay, so let's go back. $1,500 for rent plus the $750 for the line of credit, that 3% payment. and $1,000 for some kind of loan that she had out. Okay, not a personal, not like those, not a grandma loan, or it's a bank owned loan. That's the only way they could pull this type of number. Then they divide that by $5,000. Ooh, 5% over. She's 5% over, so therefore she needs to find a way to be able to qualify to get to right at that 60%. So what they would then offer her is a different number. What if they dropped it down from 25 to 20,000? So what would that number look like? So it's 20,000 times 3%, $600. So now instead of a 750 per month on that line, that payment to the line, they're going to use 600 and give the limit at 20,000. So now let's recalculate. 1,500 for rent, 600 for the line of credit, and the 1,000 for that whatever payment that is. 3,100, divide that by 5,000, still 2% over. Okay, now they're going to have to offer her less. Okay, so let's try 18,000. Okay, 03, payments 540. So now we're at 540. Then we're going to add the 1,500 per for the rent, and then we're going to add the 1,000 for that other loan. So now we're at 3040 or 3,040. Divide that by 5,000, just a little bit over. Do you see how they counter your what you apply for? It was 25,000, and now it's going lower because of the payments you got to make every single month on your other debt. That is debt to income ratio in a nutshell. And being able to calculate these things out and getting to that number that you could actually grab. So in her case, we're just probably going to bring it down to, let's just call it 17,000 times 0.03, 510 plus 1,500 plus 1,000. Okay, see, it's just one little bit over, $10 over. Divide that by 5,000, 0.2% over. So they would probably accept that right there because they round down. But it started at 25,000, and because of her rent and because of that extra $1,000 she has to pay to another loan, she could only qualify for 17,000 instead of 25,000. So knowing this information going in and knowing their qualifications of 60%, like let's say it was 45%. If it was 45%, then she wouldn't be able to get anywhere near the amount that she needs because 45% is much lower.
Wow, that's really good to know, Richie. Now, MK's got a question here. He wants to kind of know, is the bank estimating payments on every credit balance? So that's what's really taking place. The reason that they're looking at that 3% is if you were to have maxed out that line,
yes,
and then you have to make the minimum payments. And,
exactly.
So even though you don't have that actual payment, they're just assuming, they got to make sure, like, hey, if you max out this credit line and you got to service these monthly payments,
will you be able to?
Okay.
That's how they qualify you. They're basically, again, risk mitigation. They're looking to the future and saying, what if the worst happens and this thing maxes out? Will you and your current situation be able to pay this per month? And if they, and the reason why they go with 50, 60, 45%, whatever it is because they want to be able to leave the other percentages for your regular expenses, such as your taxes, your insurances, your food, your living expenses, right? They feel like up to 50%, 60%, or 45%, whatever the bank decides to choose, up to that particular percentage is left for what the bank should get from you every single month, or up to that point. So depending on which bank you use. So this is like one of the more basic ways to calculate debt income ratio. But yes, that is correct, Ray. That is absolutely correct the way you explained that.
Awesome. Good breakdown though. This is extremely important.
Yeah, it's really fun to, again, to go into and knowing the game, right? Isn't the game more fun to play when you know the rules? Otherwise, going into it blindly and well, no, you're supposed to go this way. The goal line is that way. You're moving backwards because you don't know the rules. this is what most people do when they get into this particular strategy is they see something, right? They see a presentation or they see a small training and they try and do it themselves, but they don't know the details, right? And that's why it's so important to get educated. So these details really, really help give you that ability to open up more doors instead of being, you're wondering why your credit is so great, but you're getting your door shut in your face. Well, it's probably because you're going to the wrong bank, or you have the wrong DTI, or you have, all these other things not in place yet, right?
So really being able to qualify yourself before you even go in the door.
Yes. I mean, can you imagine being able to be a part of a group of people who think the same way and run scenarios with you? Wouldn't that be neat?
You know what? I've been part of that, and it's amazing. I attribute that to where Joseph, and myself and you, really have gotten to where we are.
Yeah, for sure. It's it's so neat to always get this the feedback, right? So hey, today's for example, First Hawaiian Bank, they stopped offering the $20,000 line stated income line of credit. So now they go by these rules. Okay, cool. I know exactly what to do to qualify for that $20,000 line of credit from First Hawaiian then. Uh, so now I just got to adjust my finances and adjust my way of doing things to cater to that to get that $20,000 line of credit, right? So yeah, that's basically what it looks like. And this is the reason why a lot of people who have a lot of credit cards, let's say they have zero debt on them, but they have a lot of credit cards. Some banks will actually look in and say, what if you max them all out? Your debt to income ratio is going to be in the garbage. No, I can't approve you. Right. So that's that's the reason why. It's almost like to the point where I think I had this happen to me before, um, where I had too many credit cards open at once, but they're all zeroed out, and which is a big no-no, by the way. Just so you know, if you want to learn more about credit management and everything like that, that could be a whole other thing. But let's say I had all these credit cards open, but zero balances on them, and then I tried to get another one, and they're like, "No, you need to close like 5 of those other credit cards to be able to qualify for us," kind of a thing. And that was, I called them up and asked them why was I denied, and then I talked to their supervisor. I went total Karen on them. It's like, why not? And then they basically told me, look, you got a lot of credit cards open. We just can't take the risk. It's like, okay, fair enough. And so that's how that worked out. Still never got that card yet, but that's fine. I don't need them. But anyway, so there's this credit scores, and then there's this debt to income ratio. Okay, these are two of the major points when it comes down to learning what to qualify for. Okay, and the funny thing is like each line of credit that's out there, they ask for different things as well. I know that I have a bank over here that when you want to open up a business line of credit, believe it or not, their personal line, they go through you like full on almost strip search you to find out exactly how you manage your money personally. But as far as a business line of credit over there, oh, just tell us your stated income. What? You basically probe me to find out how my finances are personally to be able to get maybe a $50,000 line of credit for personal line of credit from the personal side, but to get a $50,000 business line of credit, it's like, here you go. What? So when it comes to business lines of credit, in this particular case, generally, again, risk mitigation, the only reason why I was able to get that kind of line of credit like that was because, well, number one, my credit score is above 680, and that's the personal credit score in this particular bank. I know that if you talk to Ray and Joey, you want to find the bank that doesn't look at that kind of stuff, but this one does, and I wanted it. I wanted to use it, and the other thing that they look at is not your debt to income ratio, okay, but they also look at how long have you been in business. Or business lines of credit. This is one of those qualifications that can be hit or miss depending on which lender it is, right? Because there's a lot of lenders who doesn't care about these at first. But if you want to get the bigger lines, then you're going to probably have to say, well, I've been in business for 2 years. Okay, prove it. So that's basically what my bank needed. It was my articles of organization and just basically my LLC binder to prove that I have been in existence for at least 2 years. And they didn't even look at they didn't look at stubs or statements or anything like that. All they just wanted to know was my credit score was 680 and above, and my business length was over 2 years. That was it. And it was a nice one. It was really neat to be able to pull that and make that happen. And believe it or not, this particular bank was open to working with all three of my companies, $50,000 each. I did it though. Unfortunately, they actually report that on personal side as well. So there's a give and
That
take,
is
right?
though amazing.
It is.
And knowing that, I mean, once like if it is something that does report on the personal side, that's better that you have a lot more, because being able to maintain your utilization, you're only going to use so much.
Right. Correct. Okay, awesome. So those are the main things I wanted to get to when it comes to qualifying. What to know about. This is not it. There's more, because all banks are different. Again, there's all these different ways to calculate debt to income ratio. I could spend a whole day on that because there's so many different examples between different banks on how they calculate and how they qualify. What does 60% mean to them? What does 50% mean to them? What does 45% mean to them? Those types of things are how they qualify people and how much they were able to give as far as approved for anyway. And then of course the credit score thing. The problem with this strategy, I got to say, is the the majority of the people that really look into the strategy tend to be the people that need help. I mean, the people may be curious about how to get rid of debt and everything like that, and they just need the help. And sometimes it turns into well, kind of like a cry for help. Okay, and sometimes the different depending on the type of person, sometimes they follow the process. They hear what we have to say, and we show them the numbers. We jot everything down for them, and then they go out and do the thing that we tell them to do, right? Or not advise, but give them the options that they could take, and then they choose the option that they want to go with, right? Then there's the people who just want it done. They just want it instant gratification. I want it done right now. I'm sick of this. This looks like a great strategy. You showed me the numbers, but now I want it done right now. Okay. There's so many factors. There's too many factors actually to be able to grasp between, the chances are for me, the hundreds of people that I've helped, every single person had a different solution. Every single person had a different situation. Therefore, every single person had a different solution. And how much time do you think that takes for one person to coach on? It is tremendous. It's just not, well, it's not feasible. And so that's why it's important to know, where you can get this information from in just like, maybe a bunch of videos, or, something that where you can get it all in one and have all the process done. And then when you have that down, that would save a coach so much more time because you already have an idea of what your plan is. Now you got to figure out where to go, right? Because these instructions will never ever tell you exactly where to go. That comes down to you and your ability to ask the right questions, go to the right places and ask the right questions, and build the right relationships. So therefore, you could really hone in on what's possible for you beyond just paying off debt. Now, there are some people out there who are able to just get lucky and say, well, you know what? I just opened up this personal line of credit over here, or this credit card over here, or this home equity line of credit over here, and it changed my life because I implemented the strategies that this concept creates. And that's awesome. Keep doing that. But there's going to be a time when the bank changes, right? Because banks change all the time. And when that bank changes, what do? If you don't know what the next step is, then you're going to get stuck. And being stuck is the last thing I want people to go through when it comes down to this. It does take knowledge, it does take some relationship, it does take delayed gratification when it comes down to it. When I started doing this, I didn't expect the results so quickly. I was still thinking about myself in the future. There's so many things going on in my mind on how this is going to work for me and my family, and paying off that 36,000 in 6 months blew my mind. It just, we were just, what the heck just happened? We have no idea. It's like we just followed the process and it worked. There's got to be more to this. And so that's when I started using it for wealth building strategies, and tying it into all these different aspects of my life, my taxes, my life insurance policies, my real estate investing, and my retirement accounts. Being able to take this concept and embed them into so many different aspects of my life, and make it work in so many different ways. And it's just endless almost. But if you're just looking for the thing to just pay off your debts and that's your goal, then reach out to Ray and Joey and see what's possible with wise guys and ties, and seeing what processes you may have to take to get to that point. It can be really simple, type of, here, check this out, use this strategy, or get this education. Get this education service, and it'll teach you along with all these other things to use a strategy and then take it forward with you. And if you want to build upon that, then let's talk. Let's see what's possible beyond that, right? So that's what I wanted to share today, Joey. I mean, I'm sorry, Ray. Uh, you look like Joey sometimes.
Hey, I take it as a compliment. He's a good-looking
Yes,
fella.
he sure is.
But Richie, I gotta say thank you. This was extremely valuable. I know that everybody that attended tonight definitely learned something and got a lot of value to take to really be able to build those, add to the building blocks of what has already been started. And so this is just one of those other tools in our tool belt to make sure that we can beat, really, I mean, if you can't beat the banks at their own game, you might as well join them and know how to play that game. And so really just playing it as a skilled athlete, because that's really what it comes down to, being successful in anything. It's going to take practice, it's going to take training, and also a team to go with you on that. And so I always recommend, hey, if this is your first time or if this is your 20th time, reach out to us. I'll go ahead and share our contact information on the screen here. And if you'd like to talk with Richie, yeah, we could connect you with Richie, talk with Richie, myself, Joseph Smith. We are here to help you folks, help you really expand in your knowledge of wealth building, expand your knowledge in the debt pay down strategies. Go over to wiseguysandties.com and click on schedule with us. There's a great place there where you can find out more information as well. But I just got to say, folks, each and every week on Tuesday nights, we're coming here to really expand in the debt pay down, the credit banking strategy. Make sure that you like and subscribe on the YouTube channel, because we had a couple of folks asking if this is recorded, and it is. You can go find this and review this information over on Wise Guys and Ties YouTube channel. And other than that, we're gonna have to bring you back, Richie. I know you got a lot of really good information for us, so Joseph and I are going to have you back potentially next week. So
Yeah, that'd be fun.
I'm excited. I'm excited. Other than that, once again, Richie, thank you. And for everybody else out there, if I don't see any questions, if you had any questions, there was a few questions that came through, but it looks like nobody at this time has any questions. You just melted their minds. Blew their minds, of course. So like always, if you have any questions during the week, feel free to reach out to us, send us an email as well. And other than that, We will see you Thursday as we discuss more real estate investing strategies, and next Thursday, or actually next week on Tuesday, when we continue the journey to achieving that American dream of financial freedom. Oh, let's see. We do have one person in the chat here. Let's see. Where's that at? Yeah, see here. Let's just make sure that we don't have any other questions coming in. Like, oh, Reginald says, thank you for your knowledge. So awesome, Reginald. Thank you for being here. And, I just want to give a big shout out to everybody who attended tonight. We have Carmen, we got Dennis, we got EC, we got Gwen, we got Larry, we got MK, we got MM, we got Michael, Paul, Peter, Philip, and Reginald. Man, so grateful for you folks coming out tonight. And we will see you all next week. Good night and God bless.
All right. Take care, guys. Thank you.